Hello everyone and a very warm welcome to today's stock markets update for Wednesday, April the 9th, 2024. That was quite a bullish reversal we saw today, of course, due to the positive news that a lot of the tariffs had been reduced, whereas that for China has been increased. Regardless, we are seeing some very extreme readings which tend to coincide with bottoms. We leave the news for what it is, and we're simply going to look at the underlying technical aspects of the market. Those are irrefutable facts we can work with, and we're going to compare it to history. What did the market do when we had such extreme readings? Most of the time, it bottomed. If not, it was very, very close to very significant bottoms. Then we're going to align that with our Elliott wave count and see if that matches. And I do want to point out that please don't pick up pennies in front of a steamroller. This means that if we are tracking a final fifth of a fifth wave lower, do not bet on that one. For my premium members, if you remember, in the email I think I wrote on Monday that I had been buying every day since Thursday at the open and at the close. Just small tranches every day, because in the long run, this is a fantastic buying opportunity in my humble opinion, unless this market goes to zero. But if it goes to zero, our society will collapse. There's nothing left, all right? It might take a few years, but I don't think your money is all worth that much by then. We have much bigger fish to fry. So your focus should be on the bigger picture, okay? If we get that close to a low, please keep a big picture overview. Do not try to make your fortunes on that last fifth wave, because remember, fifth waves can fail, and we've seen most likely several failed fifth waves in several indexes, and that can happen because I cannot control the market. I can only go by standard Fibonacci based impulse patterns, and if those get invalidated, we must then use extensions. And similarly, if a market extends, it can also truncate, okay? And in this case, we might have seen a truncated one. And that is simply the reality that we have to deal with. I will go over a tweet by Peter Brandt, which is really, really good, and it really hammers home quite crudely on the difference between what you can control and what we cannot control, and how that should translate into your trading. But once again, it's very important to keep this big picture overview, and please do not pick up pennies. And that means inverse ETFs and shorts and puts, where we're pretty much wrapping up a final fifth of a C wave or a final fifth of a fifth wave. Those are extremely unreliable. That's not where the meat of your trades is. There you should start thinking, again, bigger picture, like the semiconductors. We're thinking we're going to go to about 3,300 with an upside potential of 5,000, 5,700. We're currently at 3,400. So we only have 100 points to the downside at the most versus 2,500 to the upside. What are you going to think of? The 2,500, all right? So that also means do not get caught up in the emotions du jour. Do not listen to the news. Let the market decide where it wants to go, and please keep a picture overview. All right, with that in mind, let's go and assess the price charts. I'm going to start, however, with some of these extreme readings. All right, we're going to start off here all the way in the lower right corner with the bullish percent index for the S&P 500. Yesterday it dropped below 12. Okay, I think it was at 11, something like that. Now, let's see what happened to the stock market if we got previous low readings like that. We have one, we have two, three, four, a couple in 2009, and one here in 2002. 2002, very close to the end of the bear market. 2009, very close to the end of the bear market. 2019, very close to this correction. It was a steep one, 25%, I believe. 2020, bottom was in. 2022, one steep, very good bounce, and then a final lower low, also at the extreme low reading. So we have 1, 2, 3, 4, 5, and then 2009 is of course very extreme. 6 occasions where we either are very close to the bottom or the bottom is in. That's how extreme yesterday pretty much was. We've gone up a little bit, but again, it shows you the amazing risk reward. All right. This is your risk, a little bit of risk. This is your reward. It is most of the time triple digit rewards versus single double digit risk. So focus then on the reward. Do not try to squeeze out the risk, right? Don't turn it upside down. Don't turn it upside on its head. Look at the bigger picture. And this is data going back to 1996. I wish I had more data, but this is about 30 years of data, and we have 1, 2, 3, 4, 5, 6. So every fifth year on average, you get an extreme reading like this, and this is the return. All right, that's one indicator. Great. How about the volatility index? I have data going back to 1990. Again, that is about 35 years of data. I'm sure there's more data available. This is what I have. We had a VIX reading above 50 yesterday. All right. That happens very seldom. 50, 50, 50. All right. Not even in 2022, not even in 2020, 2002, etc. in severe bear markets. Only 2009 and 2020 did we see readings above 50. Both of the times, fantastic risk versus reward. So think big picture. This is your risk. This is your risk. This is your reward. This is your reward. All right. Think please about that. Again, it can't predict the future. It doesn't. But it tells us that, you know, if past performance is any guarantee for future results, this is what we're looking for. All right. This looks fantastic. It looks absolutely fantastic. So it's been quite extreme from the VIX. Now we have another reading here. This is, let's see here, I believe the breadth thrust indicator. We're below 35. Well, this is data from yesterday at 33. What happens if we go below 33? All right. There are several occasions where it happens, but every single time it occurs pretty close to bottoms. It's not necessarily always the bottom. That's something else, but it shows you that once again, the risk reward is very skewed towards reward. Okay, and now we have to wait for a potential spike thrust event. If we move back above 0.615 within the next 10 trading days, I think we now have 9 left because this was yesterday's reading for April, then we should see, of course, fantastic returns. All right, please bear that in mind, pun intended. All right, what else is very extreme? Well, the MACD. The MACD was minus 150. It's never been this low. Not in August last year, not in 2022, not in 2020. 2020 was already the most extreme oversold MACD reading in its history because before 2020, the hourly MACD never went even below minus 50, not even in 2009. So once again, an extreme reading, all right? And extreme readings means the band is stretched extremely far to the downside. It will snap back, and it will snap back hard. And that's currently what we're seeing. This ball has been kept underwater longer and deeper than ever before, and it will most likely burst above the surface harder and faster than ever before. All right, I wanted to show also, and I don't think I have it here, the VIX VXV reading. All right, this looks at short-term volatility versus longer-term volatility. Also here, we had a reading of almost 1.275, which is extreme. Above 1.25 is extreme. So you divide the VIX by the VXV, all right? And as you can see, that has happened 1, 2, 3, 4, 5, 6 times before since 2008. I only have data since 2008. Again, shows you very rare occasions. I wish I had data going back to 1908, but this is what we have. And every single time, you can see we're getting quite close to a bottom instead of a top. 2009 was, of course, extreme, but 2009, we already had a year plus of a bear market, okay? Currently, it's only been 7 weeks. That's it, not even 2 months, 7 weeks. And the decline, I'll show you in a moment, has not been 20% on a closing basis. So technically, in my humble opinion, this is not a bear market. Bear markets, in my humble opinion, need to be over 20% and last longer than 2 months. Everything else is a correction. So that's also extreme. That's extreme. And here we go to the new lows. I've shared this with you before. And on Monday, the new lows spiked to about 1150. All right. You can see it here in the right corner, right there. 1150. It has resided now to about 580. That's quite mellow. So on a closing basis, we still only have a 19% correction. I would say anything that is above 20%, round up 19.8 to 20% is a bear market, but it has to last for more than 2 months. Currently, it's only 7 weeks, exactly 35 days. So currently, it's still not a bear market. Okay, that's, if you use it as a definition, we're fine. This is not that bad yet. Can change? Of course it can change. But I just wanted to point out that, again, we are at very extreme readings. And readings, what's your forward return? Remember, bimbo. Okay, any bear market is a major buying opportunity for anybody who can look a little bit further ahead than 1 minute or 1 day or 1 week or 1 month or even a year. Okay, again, I've been buying in my long-term account every day since Thursday, and it's only been 6 days. That's it, right? Yes, 6 days, 6 trading days. That's it. 5, 4, I don't know. Very few, and we're back to square one. We're back to where we were last Thursday. All my positions are insanely green. All right, thank you very much. That's how I do it. Short term, I stay in cash. That's it. I stay in cash. I have a few other positions, but predominantly cash. That's it. It's not a trading recommendation, but it's a great way, I think, to approach these markets. All right. What else do we have? Let's see. This is the AD line, and the AD line is, of course, currently in a strong downtrend. So there's nothing positive about this one, right? There's always something that's not right in the market, and the AD line doesn't look too healthy yet. It needs to break above these downtrend lines, the orange one and the blue one, and ultimately above the red one to get this long-term negative divergence of the chart. So resistance will be here, and I'm pretty sure the market is going to respond to it. All right, so that out of the way, we've gone through market breadth in these very extreme readings. Let's see what the Elliott wave count tells us. Our preferred wave count is for the NASDAQ and NASDAQ 100 to have topped in December last year for wave 3, and wave 4 should have ideally completed yesterday/today. We can count 5 waves lower from the March bounce. All right, so we had here wave 1, wave 2, wave 3, wave 4, and the current wave 5 has subdivided into 5 smaller waves right there. And now we're blast off. I'm pretty sure we're going to retrace a lot, etc. Okay, that's probably the path going forward. But I still think the view should be to the upside. And maybe, who knows, tomorrow we gap up much, much higher, because there's, of course, extreme room to the upside based on how oversold these indicators are. So we've done 5 waves lower from this wave 4 low. Another one that has completed. So again, 1, 2, 3, 4, and 5. Okay. Another one that has done really well from an Elliott wave perspective is the IWM. We believe it has completed 5 waves lower. Now the monthly chart, which I'm going to share in a moment, suggests we might see 1 step lower, but here we have 1, A, B, C for 2, 1, 2, 1, 2, 1, 2, etc. 3, 4, 1, 2, 3, 4, 5. Today's low was below that of the previous lows, so we're good. That's all we got. We've completed 5 waves lower, in my humble opinion. Haven't broken yet above the key level here at 195, because then, of course, the rally will overlap with the wave 1. Other indexes have done so, but this technically has done enough. Okay, so once again, the risk versus reward is more skewed towards reward. And then we can have indeed what I would call a irregular running flat wave 4. Again, on the monthly time frame, we might see something of a bounce, so a higher close, and then still a lower price into that 150, 170 zone. But once again, that will complete wave A or all of super cycle 4, A, B, C, and then on to new all-time highs. Okay, that's really what we're looking for. And if it's only wave A, it's a little odd for wave A to be by itself a flat. We're then going to again retest the all-time highs. So once again, yesterday and the day before, your risk or reward to the downside is about 20, but your reward to the upside is about 50 to 60. All right, so there, once again, think of that. Moving on to the NASDAQ 100. As you can see, we have firm overlap with the wave 1. So this cannot be a wave 4 anymore on the NASDAQ 100 either. 1, 2, 3, 4, and then we have a failed 5th wave. Okay, in the futures market, the low got awfully close overnight to this wave 3 low. Again, I do not make the markets. I don't like, of course, truncated 5th waves, nor do I like extended fifth waves and all that stuff, but it is what it is. And most likely we will now move forward into the target zone for at least the B wave, right? This B wave here should probably revisit the all-time highs if this is indeed a flat A, B, and then of course C, okay? That we have here in the weekly chart, which we shared with you before. So we can still, of course, do the B wave higher and then a C wave lower here to about 50% and then this path, okay? But it doesn't have to be that way. We can also instantly go to 24,000 to 28,000, okay? Again, in a diagonal, the third wave tends to get to the 123.6% extension. And we got pretty close here. It was 6.8 versus, I believe, 22,300. I think we're off by 2.5%. That is acceptable. What I do want to point out once again is the buying zones here for the RSI. All right. So when we get this extremely oversold, the risk reward is skewed towards reward. Moving on to the Dow Jones. The Dow Jones can also have a failed fifth wave. The futures reached 36,690 overnight, and the absolute low was at 36,515. So it's only off by about 175 points out of 36,000. It's very, very minimal. Okay, we've not yet breached the wave one high. So yes, technically, it can still be a fourth wave. Okay. The Dow Jones, once again, doesn't have to do what the NASDAQ 100 does. But I think the NASDAQ and NASDAQ 100, as well as the IWM, show, all right, most likely this is not a fourth wave. So this is now our alternative. Most likely the low is in place. And that matches then with our bigger picture wave count, where we believe this is in a larger ending diagonal. And then wave B of wave 3 has completed. All right. So we have wave 1, wave 2, an A, B, C for wave 3, and then of course ABC lower for wave 4, and then either an ABC higher for wave 5 or it's going to be 5 waves. Okay. An ending diagonal does not have to be only 3 waves. I've seen different types of diagonals, both leading and ending, which are combinations of 5s and 3s. But once again, I do want to point out that we had, of course, no negative divergence here on the MACD. Very nicely overbought conditions on the money flow, which always suggests that we will go higher on negative divergence. Now, from a timing perspective, in a ending diagonal, we should reach at least 123.6, potentially the 138.2. The third wave is just not as strong as in a standard impulse, which should reach 161.8. From a timing perspective, we're looking to late 2026, potentially all the way late 2027, depending on which extension we're going to target. Maybe we're going to stall at the 100% extension. Well, then we should be done this summer. Okay, it can go really rapidly. To be determined. But this is for now the preferred path forward. Then a wave 4, 5, assuming of course we stay within this Elliott Wave trend channel. So don't focus too much on the timing, but focus on price. What a candle today. Absolutely amazing. Note the positive divergence. Money has been quite good with pouring into the indexes, as you can see. So we reached almost the 3.618 extension. And again, yesterday was 4, and then we might have a failed fifth of wave C of wave B. All right, it's maybe a little bit hard to read, but that's because, of course, the lows are so close together. Again, the futures market reached 48.42 versus 48.02, off by 40 points on 4,800 is less than 1%. So I think that that matches quite well. Reasonably well with a final fifth. I would have liked to see it lower, of course, would have been fantastic. But this is, again, why you don't want to bet on this fifth wave. It took only one tweet, all right? One tweet only to get this thing going. And yes, most of the time we'll see a pretty decent retrace. But it also shows you now the index has traded completely below its Bollinger Band for several days in a row. And that we have now enough waves in place to consider this correction complete. And we got awfully close to the third invalidation level. Yes, can still become a ending diagonal, for example, but I wouldn't want to bet on it. Now, so again, I do want to point out that this is from Peter Brandt this morning, who has traded since 1974. He says traded as long as I'm old. Okay, that's insane. He said only 4 losing years. That's insane. I've been trading since, I believe, 2010, and I think I've already had 4 losing years. So take it from the great. Take it from somebody with a whole bunch of experience. And he also says, I have no control over the outcome of my trades. Zero. Neither do I have control over the markets. All right. I prefer to use the Elliott Wave to forecast it, and it works pretty darn well. And we'll use the semiconductors to show you how reasonably well we can forecast this market. Okay. Again, he has no say if 15 of my next 20 trades are losing trades, and he can only control the controllable. What is the controllable from a trading perspective? That is the market, the size, the order, the type, and the price. That's it. All right. Only those 4 things he can control. Okay. What type of order, what size of order, and the price. That's pretty much all he can do. Then nothing else, right? The same here. I do not control the market. I try to forecast it using as much indicators and levels of weight of the evidence as possible. But my trade is not controllable, all right? Because nobody controls the market, okay? Nobody. And therefore, we can never be entirely correct about the market all the time. That's why we say we're 70% reliable and around 95% accurate. And we're going to use the semiconductors to kind of show you that statistic. It's not that bad. And if you think it's bad, then I don't know what to tell you. So this is the alternative. I think it has very little merit, but it is an alternative. It's still possible. Bigger picture. Please remember, before we move on, that we were tracking a ideal standard Fibonacci based impulse pattern from the COVID 2020 low. Why? Because that was, as we know, clearly a standard Fibonacci based impulse pattern lower. Okay, C waves are 5 waves, so this was clearly 5 waves lower. I technically initially thought that the market had completed its bull run and was going to correct, but when we then eventually got new all-time highs, I did remember that back then I was looking for highs somewhere between 3,000 plus or minus 100, somewhere around there. So that was definitely a really good trade. But these 5 waves lower merged eventually into a C wave. C waves are 9 out of 10 times 5 waves with crisp, clear 5 waves lower. What does that mean from a bigger picture perspective? That it must have completed a very large, irregular, expanded flat 4th wave. 3, 3, 5. I just showed you that that was clearly 5 waves lower. And a flat is a 3, 3, 5. So we got here 3 waves lower, we got here 3 waves back up, and then 5 waves lower. So that completes a 4th wave, so we must be in a 5th wave. So far, we've only had, loud and clear, in my humble opinion, only 3 waves up. So we're still missing a 4 and we're still missing a 5. Correct? So today's low, or this week's low, I would say, could be 4, and we're now in the final wave 5. Okay? However, that would mean that the wave 3 only reached the 100% extension, which is very uncommon. That also means that the wave 5 cannot exceed, in this case, I would say somewhere around 7,500 for a 5-is-1 relationship. Okay? So this would then be wave 1. This is 2, and then this is, of course, 3. This is 4. And then, of course, the length of wave 1 has to be equal to the length of wave 3, has to be equal to the length of wave 5, which targets somewhere here, because 3 can never be the shortest, okay? Somewhere there. That's odd. So I'm not going to favor it. And what I think is going on here is that we have this larger ending diagonal. Now, I must say it can still be a 4th wave. It would be a little bit beyond the normal depth of a 4th wave. If we go to the 100% extension then for the third of the 3rd wave, the 4th wave tends to go to the 61.8% extension. Now we went all the way to the 50% extension, as you can see here. This is a 50% retrace of the entire rally that started in 2022, okay? And that is more typical of a B wave. And so far, we've only done 3 waves lower. So if that is a B wave, then this is most likely part of a massive, larger ending diagonal 5th wave. It's quite similar to, of course, the 4-5-4-5 pattern, but the target zones will be reduced. Okay, instead of going to the 200% and the 3rd wave to the 161.8%, the 3rd on the target 123.6 to 138.2, somewhere around 6,700, 7,100. Now, if we continue fantastic pinball here, or ping pong, with this lower blue trend line and the upper blue trend line, as you can see here, we should expect it to top somewhere either here or there. Okay, that's what we're looking for. And what is that? That's going to be later this year, somewhere around October, depending on which extension we're going to use. Now we can of course fall somewhere in the middle, and then the middle of course would be in this, I would say, winter of 2026. Then a 4 and a 5. This remains and is now my preferred standard Fibonacci based impulse pattern. This green little target zone here is the ideal C wave target zone. All right, so far so good. And yes, we can even go to 4,500. It is possible, but I don't really see it at the moment, not after today's very strong rally. So this matches better. Then we had here wave A, and then a subdividing wave C, okay, of A, a very hard wave B, ABC, so far lower, and we should now be in this wave C. Of course, I don't want to see price go below 4,800. That would be a serious warning. Definitely not below 4,500. And if we go at any moment below 3480, I mean, this bull is over. But once again, I think I've clearly shown why this is not 5 waves. We're still missing at least one wave. Okay, at least one wave. All right, on to the semiconductors. So once again, why do we say we're 70% reliable? Well, it reached here the ideal third wave target zone. That's 1. It reached here the ideal fourth wave target zone. That's 2. And it did not reach the ideal fifth wave target zone. It decided to extend. All right, so that is 2 out of 3 correct. What did we then get? 1, 2, 3. We bottomed here on Monday, right in the ideal third wave target zone. So this is so far 3 out of 4 correct. Then yesterday and on Monday, we topped right here in the ideal wave 4 target zone. This is correct. So now we have 1, 2, 3, 4 correct out of 5. Unfortunately, it seems like we're not going to go to 3,200. We have now severely overlapped with this wave 1 low here. Fourth waves tend not to overlap with first wave unless we're in some sort of diagonal. Okay, those are rare. I'm not going to count on it. So this also shows do not pick up pennies in front of a steamroller. So if you're looking here to 3,200, right? So this is your downside risk from about 3,800 to 3,200, which is about 600 points. And your upside reward from here is to about, I would say, almost 5,800. So 2,000 points upside reward, right? Versus 600 points at the most downside risk. You focus on the reward. That is really your focus. Okay. So, then you say it's not working. Well, this worked, and this worked, and this worked. Unfortunately, these two might not have worked. Sorry. That is 4 out of 6. That's why we say we're about 70% reliable. Okay. It is our cold, hard facts. I personally went a little bit short here at yesterday, and I really pretty much closed it at today's open. I was kind of done with just a short-term trade. Okay. A little bit long, of course, when we bottomed here. That's about it. That's what I meant with my short-term trading account. I'm pretty much entirely cash, just a few quickie trades. So our preferred wave count is now that this blue wave B is underway. Okay, we've bottomed here in the ideal C wave target zone. Once again, with very little downside reward from a short or inverse ETF put perspective, and a lot of upside reward from a long call or regular ETF perspective. So focus is on this, all right? We're not going to pick up the pennies in the steam train here. We're going to focus on the bullet train over there. So that's really where we're still looking for the semiconductors. It dropped a little bit lower than we originally anticipated earlier in March because we got this extended fifth wave on our hands. Those cannot be known beforehand. But once they are there, we know then, we have 3, 4, and 5. And now we have most likely a truncated fifth wave. All right. So this is 5 of 5. That's truncated. Never bet on 5 of 5. Okay. And if you do, you got to trade it quick. That's really what I mean. So here we had an extended wave on our hands and here truncated. Shit, that sucks. I wish it wasn't the case, but it is what it is. I don't make the markets. I can only control my trades. And that's what I've done. So last but not least, do not forget we're going to go soon into a regime of massively increasing liquidity, and that most likely will drive the markets forward. There's a very strong correlation between liquidity and the stock stock market. We're around 70 to 80%, I would say, and that's enough of a correlation to make it a very valid relationship that we will track. And this will last all the way through July. Okay, we can't look further out than this. We'll keep you posted on it. Again, it starts to jolt already nicely coming next week. So again, we might see a little bit of some filling going on over the next few days before the next jolt of liquidity will arrive later this month, right there. Okay, that is somewhere in mid-April. That's what I have to share with you for today. I hope you appreciate this update. I hope you understand the right focus. Focus, I would always say, on the bigger picture. Don't pick up pennies in front of a steamroller. Do not bet on fifth waves, but layer in, because again, bimbo, any bear market is a major buying opportunity for those that want to look a little bit further ahead than just 1 minute. And the smaller the time frame, the more variable the market becomes and the less predictable it becomes. Okay, you can see already on the bigger picture chart, all we most likely need to do is change the fourth wave to a B wave, but that we're most likely still missing a fifth wave or a C wave higher to new all-time highs. All right, that's pretty much the difference. It's a little bit potato, however you want to label it. So we keep tracking things. I think we're still nicely on track. Actually, we might not have seen as deep a fifth wave for some indexes. IWM did its thing. I think the NASDAQ did its thing, and the rest, you know, that's unfortunately what it is. It was really setting up nicely. Futures market as well, off by 1 or 2% at the most. So this is as good as it gets, my dear friends. Take care, trade safe, and have a great rest of your day.